Good morning, everyone. Today we are the 23rd of March 2020. This is a webinar for the City University of Macau for the Faculty of Business students. So the topic of today is an update about the virus crisis and its impact on the global economy and businesses. My name is Marco Risolio and I am professor in City University. So this is what we are going to talk about during the presentation: the actual situation, the macro impact of the virus in the supply chain, but also at a macro level and we will see the sectorial impact through several regions across the world. And then we will spend some time also on the financial market impact, which has been quite huge until now. And we will end our presentation with the forecast scenarios, what to expect in the coming months by region. So with the data we collected today, the infection that have been confirmed now, it's around 169 countries and territories according to World Health Organization. This means that 90% of the countries on planet have cases of infections of the virus. So as per today, we are speaking about 336,000 cases reported worldwide. So we need to know that there are two things here. We have two tsunamis spreading around the world. The first one is a sanitary crisis, where people's lives are at risk, especially the elderly population. Okay, and that's the most important one that we need to fix. But then there is another one that we cannot underestimate, which is the economic crisis. And this is affecting private and public sectors, especially the small and medium enterprises, but also very big multinationals globally. So there is a disruption in supply chain, and that we're going to talk about that. And of course, all of this brings consumer activity that is slowing down and is leading to a global recession. And we will try to understand what are the consequences of this. So this is the first slide published by New York Times on the 21st of March, so 2 days ago. And this is very important. It's just you need to understand here what I meant. So basically, this is the average number of new cases each day, okay, by region. So we can see here the countries and regions more affected. But most important with this slide, what I want to point out here is the timeline of the spread of the outbreak of the virus. Okay, we started in China, of course. So here you see number one, we started in China, in a city called Wuhan. It started in January, and you know, the big lockdown on the economy. It started at end of Jan, but especially February and now March, and probably first week of April. But we are talking about 3 months here of the delay of disruption of supply chain. Then the virus, the outbreak goes and spreads out, and then we can say that the second region affected is Europe, and Europe is in the middle of it. So first cases started to appear on February. So I will say that February, March, and April will be the most affected months. And finally, we've got the American continent with South America and the US. It's just starting now. We just saw New York announcing this on Saturday that they will do some lockdown, so restrain movements. So we've got until now 3+1 states. So California was the first one, Illinois, New York, and also we have Nevada. You know, Nevada has closed all casinos actually. So yes, so we are talking in a time lapse going to Jan to May, where the economy will be shut down by phases. Okay, this is very important to understand. Why? Because we can see that China probably will be the first. China and Asia will be the first continent region to maybe get out of this crisis if everything goes well with the containment of the virus. Europe, we are just in middle of it, so we still have to wait. Probably you know, April, and the US just started, and Latin America, so probably in May. So the timeline, um, this timeline in mind we need to have, because this is has an impact in terms of the economy. So what means, of course, when there is the virus, what we mean, we call this partial lockdown of the economy. Just as a reminder, China was the first one to adopt this crisis. So this is insane, the numbers, but 800 million people in China have been partially locked down. This represents 10% of the world's population. You know, never in history we had something like that. So as the coronavirus continues to spread, some countries are putting their citizens on lockdown. We've got mandatory quarantines and border closures. So the strict countries are, for instance, Denmark, Salvador, France, Ireland, Italy, New Zealand, Poland, Spain, Portugal, and the US now with California, Illinois, New York, and Nevada. So we can say, if we sum up all the population of these countries, it's around 15% to 20% of the world population that has experienced strict lockdown. Just a little, so this is a graph by Reuters, estimative on the lockdown in China. And just to let you know, in China, the majority of the cities have there is no more restricted movement policies. Only Wuhan and few other cities there is this restricted movement, but the other ones now it's easy, and China is getting back to work since a few weeks now. So if we add up, so if we add all the less the restrictive, the hard lockdown of the economy, so countries like France, Spain, Italy, China, if we hard if we sum up the GDP of these countries, because we are talking about the most richest country in the world, and as you know, the GDP is the world GDP basically is 10 countries in the world that have 70% of the world GDP. So if we had all these countries, we can say that 25% of world GDP is affected right now with hard lockdown. And if we had the less restrictive measures implemented by other countries, we can say that 80% of world GDP is being affected right now. This is huge. Going for the next slide. So of course, this is has an impact on the economy. So this is the GDP, the economic growth, so the gross domestic production, GDP. And this is a Bloomberg chart. As you can see, now the global growth is only estimated almost at 0% globally. And this is the two scenarios, you know, with coronavirus, and one with the severe pandemic. You can see that some countries like Italy and Japan will have even you know, negative economic growth. So yeah, but one thing to tell about these projections of economic growth, this is changing, I would say, almost day by day or week by week. Every bank, Goldman Sachs, Morgan Stanley, they are changing the economy, slashing down the economic growth forecast on weekly basis. So yeah, and this is an example. This is an example of the reality, the economic impact reality. This is the air traffic chart. It's called Empty Skies by Bloomberg. And as you can see, this is the air traffic is experiencing right now the largest slump in history since we are compiling this data since 1978. In the 5th of March, there was a press release by IATA, which is the International Aviation Agency, and they said that airlines are facing revenue loss of between 63 to 130 billion US dollars. Okay, and why? Because airlines are maintaining travel restrictions to contain the infection, not airlines, the countries. I don't know if you heard the news through the weekend, but Emirates Airlines, they shut down all the operation. No more flights anywhere. And a lot of companies are doing so. Another big news is Boeing, largest American manufacturer of airplanes. They ask for aid 60 billion US dollars to the US government. If not, they will enter in bankruptcy. Let's continue. So when the economy is impacted, we need to see which are the sectors that have more exposure and the ones that are less exposure. So usually we could think that high exposure, when there is an outbreak, of course, manufacturing will be a high exposure because, fabrics will stop, factories will stop, right? Consumer durables, so durables like TV, frigo, this kind of stuff, people will not buy. Discretionary, which is the luxury goods, this is the first things you cut, right? Casino and gaming, we saw this in Macau, where they closed the casinos for 2 weeks time, and we are seeing now in Nevada. In Nevada is closed. Macau reopened, but with no players. And Nevada, they almost, the big casinos, they all closed. Of course, tourism. Nobody's going to travel during an epidemic. So hotels, leisure, restaurants, cruise lines are suffering. Airlines, we just see a previous slide as an example. Transportation services like shipping, wholesale distribution, retail, oil and gas and petrochemicals, because there is less demand. And at the end, finance and banking. Why? Because banks and insurance are under pressure. If there are some bankruptcy happening in the market, banks they live from loans, right? So that's high exposure. And on the low exposure, on the right, on the green side, so consumer staples, when you do the quarantine, you need to buy consumer staples, non-durables, food, drinks, anything, healthcare, masks, alcohol to clean, and other pharmaceutical products that you need. Real estate usually also is good. It's more strong than having equities or bonds. Telecommunications and media should be also a good one, because everybody will be playing on their phone and seeing news and using their mobiles. Utilities, because they always produce electricity we always need that. Aerospace and defense should be one not affected, but we will see that this is not always true. And then IT software services, like Zoom software using by everybody. Food and beverage, we just talk, and natural products. So this is a source by Moody's, Rothschild Bank. This is what should be, but we will see the real impact on the market later on the slide. So let's speak now about China before speaking about the rest of the world. So China now represents and accounts for 70% of global GDP, compared to 4% in 2003. So 20% of global trade versus 5% during SARS in 2003. So this is huge. China, the moment of China is now, is this decade. Is unbelievable, the share and the weight on the economy that China is right now. And this, of course, when it started, this had direct impacted some of countries, and then we're gonna next. So this is another interesting slide by Bloomberg and IMF. So in 2019, these are the 20 economies that have contributed to the growth of the world. And as you can see, China is really the brain of growth of the global economy. The United States comes very far, I mean, in third place. So China represents 32%, contributed to 32% of the growth of the global economy. You know, it's if you sum United States and India and all other economies combined, you know, China is still number one. This is tremendous. And of course, if China doesn't work, the global economy doesn't work. So this is another interesting chart. This is the share of the GDP of the countries with the representation of China. So just an example here, the two first one, you know, Singapore and Hong Kong. So 25 of the percent of the GDP of Singapore is direct linked to China. If China shuts down, Singapore shuts down as well, because 25% of the GDP comes from China. Hong Kong is the same, almost 20%. Taiwan, Australia, even countries like Germany, almost 10%. You know, France, 6% of the economy. The United States of America, 5% of the economy is linked to China. So yeah, so this is a slide is most to see the share of GDP by country of the importance of China. One territory for me is missing here because we are in Macau. If we had to put Macau in this chart, this will be in number one. Okay, I would say that Macau, the China share of GDP in Macau will be at least at around 60%. So we are the most depending economy, Macau, in China. So going to the next slide. So how coronavirus infects global supply chain. This we talk a lot of global supply chain. For the students that don't know exactly what is meaning the global supply chain, we are talking, when we talk about supply chain, we are talking about a network between companies and suppliers to produce and distribute products to final consumers. Okay, so of course, if this network it includes as well different activities, people, entities, information, and resources. And as you can see by the graph, this is the share of all imports of intermediate products coming from China. Okay, this is a Bloomberg graphic. As you can see, Latin America and Africa depends a lot on these imports from China, more than 35%, 40%. And but if you see countries like the US here, you know, US also 30% or share of all imports intermediates going to the US or produce in the US, I mean is depending on China, you know, producing laptops, producing mobile phones, you know, these components, they come from China at 30% level. So it's when the economy shut down and there is no logistic, no transportation, you know, the whole supply chain is affected. And of course, guess what? Companies were not ready. Look at how many companies had supply chain policies at a global level. This is a Reuters graph from Refinitiv. At a global level, only 46%, so half of the companies worldwide have supply chain policies. So when something like this happens, companies have nothing, no due diligence plans, no backup plans. So they take time to 1 to 2 weeks to re-implement and to find out what they need to do. So another graphic, but it's a little bit old, this graphic. This is from February 27. Today we are March 24, so there is 1 month. This chart is 1 month old. It's a survey asking company experts on transportation, how many weeks you think will be the delay of the shipments here. So when we talk about the shipment, we are talking about, you know, big containers, dry bulk. We are not talking about things that we send through the post to our families. We are talking about business to business shipments, and on average, you know, summing up and doing the average, it takes at least 5 weeks to in delay of the shipments. I will say at this moment, 1 month after, that probably this will be at least 6 weeks, 1.5 months to 2 months delay on big shipments. View the situation and the spreading of the outbreak. So yes, so going through the countries again. So the component, this is a graph from Financial Times showing the parts and components of electrical and electronic goods imported from China in 2018. So countries like Japan, Hong Kong, and US, if we go more specific to electronics and electrical, we can say that 50 to 60% of the components, they come from China. But look at this: India, Canada, Mexico, all of these countries, more than 40% of their components, they come from China. So huge impact there. So yeah, so this is the change in value added by selected manufacturing sectors. So we are going a little bit more down just to have a look. So motor vehicles, general machinery, railways, textile, fabricated metals that are going down, heavily down in terms of you know, production, manufacturing production. We are talking about an average of minus 20 to 30%. All of these components. Going further, I put this slide because it's very important for Macau, as you know, and Hong Kong. As you know, Macau and Hong Kong, especially Macau, we have in the casinos a lot of very high luxury brands such as LVMH, Christian Dior, Louis Vuitton, Gucci, Prada, I mean, you name it, all of these high-end brands. And for people who don't know, but the Asian market, especially China, Hong Kong, and Macau, represent a huge amount of revenue of these companies. So, for instance, Swatch, the percent share of Chinese. This is only, I think, this is only China, and not counting with Macau and Hong Kong is China. But you know, Swatch, 50% of their consumers are Chinese. Richemont, 40% of the consumer. Burberry, 40% of their consumer are Chinese. You know, the group LVMH, which owns the Champagne, Moët Chandon, Dom Pérignon, and also Louis Vuitton and other brands like Celine, you know, almost 35% of their sales come from Chinese customers. So, you know, this is the luxury segment is highly exposed to China, Hong Kong, and Macau, and right now they are suffering a lot. And of course, you know, Macau, the borders are closed, and there is no tourism, and many of these brands, they close temporarily all their shops, and they only remain with one shop open. So yes, so we spoke about China. Now let's speak about a little bit about the US. So according to a Dun Bradstreet report, 938 of the 1,000 Fortune companies have a tier 1 or tier 2 supplier that has been affected by COVID-19. Okay, so this means that all companies in the world, everybody is affected. You know, we are talking 938 companies out of 1,000. We are talking about 95% of people of companies affected by this. And this is yes, the graph that was just published yesterday. And as you can see, the US is just started. We've got the coronavirus cases across the US, and California, Illinois, New York right now are the most affected. But the situation, so 3 states out of 51. If we just see what happened in Asia, in Europe, I think that the US will have the same path, meaning that more and more states will be contaminated, and there will be more than 3 states declaring lockdown. Okay, so the government asked 2 essential jobs to be maintained. So only people working in hospitals or selling food in groceries, but the other ones need to stay at home. So it's not a severe lockdown, but is a lockdown. So people are still allowed to buy groceries, medicine, as well to exercise outside. But the rest, they need to do stay home and do work by home. So talking about the US, this is the revenue from China of the S&P 500 index. So 30% of revenue of the US companies on semiconductors comes from China and Hong Kong. Technology, hardware, we already talk about. Consumer services, etc. I'm going to skip because we already talked a little bit about this. And talking about the US S&P 500, which is the biggest American the world's biggest index by market cap, we can see that, look at this, Wynn Las Vegas in the top 1, top 3. So these are the most exposed companies in to China. So almost 60 to 7%, 70%, to almost 60 to 80% of their revenue comes from China. It doesn't come, even though Wynn has casinos in Nevada, Las Vegas as well. In Las Vegas, the Sands, even though they have a lot of casinos there, they make 70 to 80% of their revenue is here in Macau. And then of course you've got the Micron Technology, Corvo, Broadcom, Photonics. These are all high-tech companies needing electronic components, and of course the Intel as well. All the processors, computer processors. So you see a lot of them, high-tech is exposed to China, and they sell a lot here in this. So we talk about the China, we talk about the US, let's talk about the rest of the world. The impact of the rest of the world is severe through business travel and tourism, supply chain, commodities, and lower confidence is growing everywhere. So we can say from last week that the world economy officially entered in a global recession. Okay guys, so now we did an overview in terms of regions, in terms of sectors affected, but let's have a look at the market, at the financial market. When we speak about financial market, we speak about essentially the equities and bond market. So we already speak about the impact on industries such as airlines, manufacturing, etc. So what is happening is that there is a reduction with the travel restrictions. There is a reduction in consumer spending, a decline in energy demand, and factories, and retail and office hours closures. So business in almost any sector are affected. We talk about that. So this is having a severe impact on companies' financial statements. Net income, profit margin, inventories, cash flow, revenue, cost of sales, repayment of debt, market capitalization. So on the financial statements, when we talk about the balance sheet, the income statement, or the cash flow statement, all of these items are heavily impacted. And a lot of profit warnings were already announced by some companies that Q1 will be a disaster. And more than that, there will be possible bankruptcies to come. The big question right now is to know who are the healthy companies that can, surpass this crisis having very few revenue with a high cost, and who are the companies who are not healthy at all, and that will go bankrupt, that will need help from government. That's the key question to know, right? So if we analyze the impact by region until 20th of March, so a few days ago, 3 days ago, we can see that the country less affected in terms of equities market is China with minus 11%. The second region less affected is the Middle East. So Dubai, Emirates, etc. less affected, and the third is Japan. Japan is the third less affected. But even though it's the less affected, they already lost a lot in the stock exchange. China is a minus 11%, Japan minus 25%, and Middle East at minus 16%. So there is no winners here. And the worst performing economies are Australia and New Zealand. Second place is Latin American and Caribbean with minus 40%. And the third one, surprisingly, Canada with 38%. This is impact by country. If we go now the real impact by sectors with the real numbers, we can see that the worst is home building. Of course, home building, people quarantine, no workers, everybody at home. 48%, almost 50% lose on market capitalization. This is dramatic. The second one is aerospace and defense, which is strange, because aerospace defense, but yeah, it's at a minus 45% almost. The third one is hotel and gambling. So hotel and gambling, Macau. So the stocks are losing minus 44%. All the stocks in hotels and gaming sector, generally, we're talking about more than 45%. And then we talk about the air transportation. These are the worst performance sectors. The best performing sectors, they are not positive. Again, is the ones that are decreasing at a lower rate. So the first one is retail, grocery and food. They are at minus 17%. The second less worst, actually the first one is food processing. There is an error in this slide. Is retail, then food processing, and on third the retail and grocery. These are the three less affected sectors. Okay guys, this is a screenshot that was shared by a friend of mine. This is a print screen of Bloomberg terminal, and as you can see, the world is on red. This is a screenshot on the 9th of March, the first time that there was the largest single day point drop in history, and all the equities index worldwide, the stock markets worldwide went down like crazy. Then we thought that it was the only day that had break the world history record, but not. 6 days later, on the 16th of March, another single day point drop in history. So in space of 1 week, we had 2 world records in history of point drop. Point drop, not percentage change. There is a difference. And a lot of people maybe don't know, but during that week there were more than 10 indexes worldwide that halted trading for 15 minutes. There were more than 10 stock exchange in the world that halted trading for 15 minutes. This is what we call circuit breakers. When, for instance, in the US, if the index go down more than minus 7%, the stock exchange stops the trading, and so people can reflect during 15 minutes and breathe and see really if to calm down people and the panic. So this is huge. 10 countries that have halted trading in 10 indexes halted trading in the last 2 weeks. That's unbelievable. Okay, this is a graphic of the S&P Standard and Poor's 500. Standard and Poor's 500 again. It's the it's the largest equity index in the world with the largest market cap in the world. So if you can see here, if you can see here, um, if you can see here, the the maximum value was 3,041 points on the 20th February, and on the 9th of March, when we had the largest drop point, it went to 2,746 points. So we are talking about a drop point of 250 points. That was the largest drop point in history in markets. But so far, we are still, this is February 2019. The market was, we are still more than this, and we are still more than the financial crisis of 2008. And then if I go to the next slide, on the March 20, this was a 600 points drop. So now, yeah, on the 20th of March, the market hit 2,400 points. Unbelievable. So yeah, so now we are at level of 2018. This is another interesting print screen from a friend of mine also that sent me Bloomberg screen. This is on the 9th of March. It's not end of day, it's during the session, during the day. This is a screenshot on how the market was behaving. And as you can see, technology was the most hidden sector. Google, Microsoft, Facebook. I think that these companies, that had a tremendous valuation, that was tremendous valuation that didn't correspond to the reality of the market, and that's why they were the first more penalized. Second is services. Of course, services, when you are in lockdown, there is no more services. The third one was penalized is financial markets. You can see here on the left, of course, because there is always risk of bankruptcies, and people are afraid from the banks. Consumer goods, yeah, so it's scary. Even healthcare, all the market down. So it didn't only hit the S&P 500 or the American market. It hits all markets. So here in Asia has been also very hard impacted. So India minus 30%, and this is a graphic only at 12th of March, only 10 days ago. So India minus 30%, Nikkei we are at minus 22%, Korea minus 17, Hang Seng minus 14, Shanghai minus 4. Even though it went, these numbers are from 10 days ago, that the market went even a little bit further down. But what I want to say with this graphic is that, Asia is as well impacted, and not only Asia. This is Europe. The FTSE 100 in London, the German DAX index, the French CAC 40, the Italian MIPTEL. All of them have been suffering a lot. So it's a global slump on capital markets. Okay, another very important indicators, guys, for all the students here, it's the VIX index. What is the VIX index? It's the volatility index. It's known in the market as the fear index. This is a world record of 83% of volatility in the market percentage, never seen in history in markets. This is even worse than 2008 or any other crisis. And what is the volatility? Volatility is the standard deviation or the variance to the mean. So this is to exemplify what is volatility. This is what is volatility. On the worst week ever in history of markets, these are the swings. So one day, this is S&P on March 9 goes down -7, but then the next day goes +5, then goes down -4.9, then -9.5, and then goes down up 9.3. It's these swings, the up and down, unbelievable. go down very sharp and go up very sharp. This is what we call volatility, and volatility right now is very high. As you can see, 3 days of record history: 9 of March, 12 of March, and 16 of March. At these 3 times, the S&P, the US had to stop the exchange, activating the circuit breakers for 15 minutes. Yeah, unbelievable. Going down, and yeah, talking about volatility, this is a screenshot that I took from the market, from all the casinos trading in Hang Seng. So as you can see, on Friday, last Friday, I took a screenshot of prices at the end of the day, and as you can see, all the stocks plus 10, plus 12%, plus 8%, plus 9. Everybody goes up after suffering a lot. And then today, as I take a screenshot, -6, -5. You see, so this is what we mean volatility. You know, these they are. If we take, so between Friday last week and Monday today, you know, Saturday and Sunday stock exchange are closed. We are talking about 15 to 20% change in prices. This is huge. You know, if we take you know, all the scale of the variation. So where we are right now, this is a screen from Rothschild using Bloomberg data. As you can see, we are right now at -32%. So since the 20 February, which was the highest in history price of the index, until today, until last Friday, 20 of March, the stock exchange the S&P went down -32. Sorry guys, I'm gonna do just a little pause here. Okay, I'm back after putting the charger again. So yeah, if we compare, the coronavirus crisis against all other crashes, like you know, the war in Iraq, the Vietnam War, the Second World War, the dot-com bubble in 2000, etc., the big crisis in markets, you know, this is the most fastest drop of the market in history. Okay, the fastest going down. It doesn't mean, you know, it doesn't mean that this will be the worst in terms of market cap going away. It doesn't mean that decrease on market cap, but it's the fastest. Explain a little bit here. So here, the coronavirus right now, okay, it's going fast, very down. But you know, if we compare to the crash in 1929, the Great Depression, or the dot-com bubble, you know, the Great Depression in September 29 went to -80% of the stock market's prices. You know, the dot-com bubble, it went more, almost 50%. So right now we are at 32%. So let's see what's going to happen, because nothing is fixed. So this is also a very interesting graph explaining the bear and the bull market. So bull, it's in blue when the market goes up, and bear, it's in red when the markets go down. So the stock market always, you know, this is how it works. The growth of the economy and the system we are living in. We are always, you know, growing. Countries are always growing, accumulating wealth. So that's why the growth is always larger than the crisis. For instance, here from 2009 to today, until February 20 of this year, you know, we had 131 months of growth. And people who invested in market from December 2009 until today, they have a return of 400% return in the market. This is the largest period of growth in history, okay, since the markets exist. The second largest period of growth in history was from December 91 to the 2000 year, and it was 113 months, but the growth was higher, was 417%, okay. And so on down here on red is when is the depression. As you can see, depression went minus 86% in 1925, 25 to 28. Here we are just at minus, actually it's 32%, but because it's a graph from last week. But look, the difference between the other depressions here, this is a vertical line. That's the big difference. Okay, if we zoom it, you better understand. So this is where we are. 2020 is a vertical line, as you can see. So it's the worst drop in such a short time, but compared to other crises, we still didn't hit the bottom. Okay, we talk about the equities. Let's talk now about bonds. And this is the 10-year treasury yield of the American US Treasury. So as you know, China is the biggest holder of T-bonds in the US. So this is a graphic of the yield, what this represents. So basically, you know, interest rates that individuals and businesses pay to borrow money. So treasury yields in the market, guys, they are always used as an indicator on how investors feel about the economy. And this is at lowest time ever. So talking about bonds, you know, there are two ways big companies can finance themselves. One is internally through you know, if a company has good revenue, good profit margin, good cash flows, they can reinvest this revenue, this profit margin, these cash flows into buying new companies or new factories, etc. So internally, so they can finance internally if they are very healthy, or they can do it externally. And when you finance externally, there is two possibilities: or you do share, you do an IPO, basically you raise capital going on to be traded in stock exchange, and the other one is through debt. Debt can be loans, bank loans, or bonds. And bonds for big companies, this is what they are using the most, is the bonds. Issuing debt, and this is a graphic that explains very well what is happening. Here is the CDS, credit default swap, and it's skyrocketing, not yet at worrying levels as we've seen in 2018 or 2009, but it's skyrocketing. What the CDS means, CD credit default swap, is the risk of default, risk of companies going bankrupt, and this risk is growing a lot. And here on this second chart, what we have is the total market capitalization of US corporate bonds, and as you can see, there are a lot of BBB here and B. So B and CC, these are all junk bonds. These companies that are really with a lot of debt, almost bankrupt, very risky companies. One of the $1 million question right now in this financial crisis is to know how many of these BBB bonds, or how many of these companies that have issued these bonds are healthy and how many are unhealthy. That's the big question right now, because a lot of companies going bankrupt means that it can stress the financial system and can make also banks going bankrupt. But the central banks reacted, and we will speak about that. This is speaking, so we speak about equities, we speak about bonds, and now I'm speaking about commodities. So when we speak about commodities, we are speaking about oil, gas, So energy, we are speaking about mining. So mining, it's copper, aluminium, platinum, silver, etc., etc. And then we've got the third big branch of the commodities, which is agricultural products, which are soybean, corn, etc. So all of these commodities are going down because the demand is going down. This is the Goldman Sachs index, which is the most liquid and most important commodity index worldwide. Of course, the weight of energy is much higher than mining and agriculture, but is a good example. Another um, another important point here is the oil price crash. And as you can see, there was a big crash in prices of more than 30%. So right now, oil crude is trading at $20 per barrel. This graph is from 2 weeks ago. So we are trading at a level not seen since 2001, basically. And what happened in oil is because there is the coronavirus, because there is a very low demand, and China is one of the biggest importer of crude oil worldwide. You know, the OPEC, which is the exporters, producers in the Middle East, led by Saudi Arabia, they wanted to reduce the production of crude oil so they can adjust the price, so the price not continuing going down. And Russia said no. Russia said they will continue to produce the oil, and that's why there is a tremendous collapse and probably one of the most hitting sectors. And in the US, as you know, US is producing a lot of shale oil, which has a high cost, much more higher cost producing shale oil from shale than from onshore or offshore. And this is also another industry at risk in the US. Okay, the banks, the world has reacted. The world has reacted with fiscal and monetary stimulus. In terms of monetary stimulus, 39 central banks across the world have cut interest rates. In the US, almost it's zero. So basically, companies are not suffering in repaying their debt, the loans, because they are doing that at a 0% interest rate. So this is what we call the continuing policy of quantitative easing, lowering debt, lowering interest rates, to stimulate the economy. Then there is some countries that like European Central Bank and the Federal Reserve of the US, they will repurchase billions, if not trillions worldwide of corporate bonds. There has been tax deferrals on many countries, and a lot of loans have been also guaranteed in case of default. So the world, the central banks have reacted, but this, of course, will be a time bomb. This graph is from the EMF, International Monetary Fund. Probably is already not updated at all. This is the global debt before the outbreak. It was 220% of GDP. So imagine now we will go to 500, 400% of the GDP. So this is another very big issue of our society, and but we are not talking about this right. So forecasting scenario, we are almost finished here. This is the last part of our presentation. We've got growth forecast for the US economy slashed down to 24%. This is a Goldman Sachs perspective. And for China, 11% flash down. So we are no more talking about a V-shape recovery, but more a L shape, between an L shape and V-shape recovery. So economists failed to capture the severity of the fall, and they have been changing on weekly basis this. So for China, very important. I think that China. So the first 2 months of the growth, they were worse than expected. Okay, so the first quarter GDP is tracking at a drop of 20% year on year, but you know, China, compared to all other countries in the world, is back to work. Okay, uh, getting back to work slower than expected, but is getting back to work. Um, right now, using some indexes and some big data information, we know that China is operating probably at 80% of its normal level. Okay, so that's a good point. But even though the GDP will be severely impacted, a rapid recovery in Q2 appears less certain because the getting back to work at 100% will still take 2 or 3 weeks more, and so meaning that it will have to take from April data. That's why. So China is getting back to work, but slowly, but surely. Here is Hong Kong. Hong Kong. I'm speaking about Hong Kong because it's our brothers, just neighbors, and this is probably the most affected economy worldwide by the virus. Look at this: the visitors plunge. The percentage up in the year-to-year growth. The retail volume sales. This is a graphic from October, November 2019, when the protesters started in Hong Kong. So imagine now with the virus, we are talking about minus 70% of retail sales. This is a contraction of more than 70% in all tourism and retail and hospitality sectors. A double-digit slump in trade and financial sector. As you know, services has accounted for more than 90% of the city economy in recent years. So it's terrifying to see what's happening in Hong Kong, and hopefully, as Bloomberg suggests, in end of April, beginning of May, the economy should start to take again. Macau, of course, you close casinos, the gross gaming revenue goes down on the left, a slump on the gaming revenue because of the casino closure, and also because China is forbidden, has not issued any its visa for individual scheme and for groups. So right now there is nobody traveling outside China, and of course the impact on the sector. So here you've got a graph of wind, sands, SGM, MGM. I forgot here to put also the Galaxy Entertainment, but all of them. So there are 5 stocks traded in Hong Kong Stock Exchange. So Galaxy, SGM, MGM, Sands, and Win. And remembering that Malcocran has been delisted and is no more traded in Hong Kong since last year. So another, and I think this is one of our last slides. Also something I want to tell you. The traditional indicators usually we use, like GDP, like the inflation, like production, like unemployment. These are traditional indicators are dead in the sense because it's too late. When an analyst or corporate finance analyst or creditors or investors want to access data, we cannot, in situation like this where economic goes down in a very fast speed, these indicators are published only 1 month after, and this is too late. So right now what we are seeing is a lot of financial analysts using alternative data. So traffic congestion caption with AI cameras, using artificial intelligence, GPS navigation devices, air pollution, CO2 emissions, coal delivery at ports with the electricity consumption, railway coal traffic, shipping port load and congestion, container volumes, the migration between cities, the box office revenues in cinemas or bookings from apps, C3, Pop and Table. This is the data that people need, analysts need in real time to know what's going on, because traditional indicators are too late and only published on a monthly basis, and usually several weeks after the month, the closure of the month. So future of finance of analysis is a lot linked also to big data and technology. This is an example of China recovery using this big data. So here we've got the railway unload coal in the red graphic in 2020. We are already at the levels of 2018, which is good news. China is back on track. Big data doesn't lie. We've got the daily passengers volume in the metro, in the subways. And we can see that it's picking up. People are taking the metro again. Here is the traffic congestion. So people, congestion in their cars. We track this via GPS, and we can see that people, there are bottlenecks in Beijing. So in Beijing, usually there are huge traffic bottlenecks, and we can see that is already people getting back to work with their cars. And then the last one is the property transaction volume. So volume in transaction in buying and selling real estate. Again, it's picking up. So yeah, China is back, slowly, but is back. This is an example of data. This is Zhoushan vessel tracking, the fourth largest container port in China. And as you can see, slump until the February 17, 18 in volumes. And then now the volumes, the volume container is picking up since end of February. And the thing is that we only have data for the Zhoushan terminal, but we don't have data for Shanghai, Shenzhen. We are the two biggest. We don't know really what's happening there, so we don't know if we can trust if this is the same trend for all the other container ports. Guys, thank you very much. I appreciate, and this was a summary of what happened until now on the financial markets. Hope you enjoyed. Bye bye, guys.